Hello, Mike Swanson of WallStreetWindow.com here. Uh, Hello, Mike Swanson of WallStreetWindow.com here. If you would like this video so that I know that you're here. And it's been a very interesting day in the financial markets. But before I get to my thoughts on the markets, I want to tell you I've been reading this really interesting book. It's titled Reading the Market. It's actually a history book about how the Wall Street Journal came into being and the first how the industry of writing about the financial markets started, and how the people that were writing about the markets were writing about the markets, and how the stock market was depicted in such things as art and in cartoons and so forth. It's really about how people began to understand the markets and what words they use to explain it. There's a phrase that I used to hear a lot when I started out in the 1990s, that bulls and bears can make money, but pigs get slaughtered. That's a phrase you really never hear anymore. But in the 90s, it was everywhere. And the idea was that if you trade the markets, it doesn't matter if you're a bull or a bear, you can make money. But if you're too greedy, it's going to catch up with you. And that's something I'm going to return to again in a few minutes. But first, I want to talk about something I learned in this book that I never realized. There's a painting I've got right behind me, or a print that you often see in my videos. And I thought it was a neat print. It shows you Wall Street and bulls and bears running around. It looks like they're fighting each other. But this painting was made in the 1880s, at the turn of the century, and there's something about it I never noticed before that's in this book, and I want to show this to you. And let me load it up. Takes me just a second here to load it up. Okay, here's a better picture of it for you. So you've probably seen this before, and the title of it is the bulls and the bears in the market. Now, what I didn't know in this painting is that there's another type of animal being depicted here that's dying. It's being hurt by the bulls and the bears, and that's lambs. In the corner in the bottom right, there's a lamb dying, and there's a couple others that are being torn apart by either one of the bulls or by one of the bears. Now, back in the Gilded Age, in the turn of the century, the people writing about the markets said that there's bulls in the markets and there's bears in the markets. Another category, lambs, and they mention them all the time. And the idea behind lambs being in the market was that this was the general public that didn't know what they were doing and were supposedly being losing their money to stock market manipulators. They could be either bulls or bears. So the writers of the age would talk about bear pools making stocks collapse, and bull pools manipulating stocks. And sometimes people in these pools would jump from one side to the other, and the lambs were people that were being enticed into the market, didn't know what they were doing, and would end up losing money to the professionals. Now, what's funny to me is I've seen this painting hundreds of times, and I never, ever noticed that. And there's so many things about the markets that people take for granted today that they're not noticing either. And they're not even really apparent to people yet. But as things unfold, we'll keep our eyes on top of things and so forth. So let's look at the stock market today, and what can we take away from the action? Well, the S&P 500 has made a new closing high. The Russell 2000 also broke out to new high, and so did many of the popular stocks. Facebook is basically on a skyrocket this month. Now, I'm frankly going into this week, I wasn't sure what was going to happen, but I wanted to see. Now, a month ago, I was thinking we could be seeing the formation of a top being put in place with the Nasdaq, because many of the popular stocks had huge rallies in May, and then on June the 9th had reversal days on huge volume. So for instance, this is NVIDIA on June the 9th. It fell on a gap up, but it fell on its biggest one day of volume ever. I thought that was very significant. And when you see a stock like this go up this much, not just over the course of 12 or 16 months, but over the course of 1 month, you've got to be on guard for a top, and at least one that's going to lead to a consolidation period for several months. That's what you can see happen from January to the May gap up move. So I thought, okay, we're going to consolidate, or we could be forming an epic top, and the next couple of weeks would tell the story. Well, here we are, and NVIDIA is testing the high of that day, with many other stocks breaking out, such as Facebook, and the S&P broke out, and the Russell 2000 also as a new high today, and so is the Nasdaq. So what is going to happen now? Well, obviously the notion that June was a top, I have to discard that and look for what's going to happen next. Now, I got to tell you that we are now getting to a point that it's starting to get crazy. And one of the reasons I thought we could be seeing a top, not necessarily the end of the bull market, but when I say a top, a coming pullback or a correction phase, something, is because historically when stocks do go up like NVIDIA did and so many of the others, that's what happens. Very rarely is a stock like NVIDIA going to go up 70% in 4 weeks and then go up another 70% by Labor Day, basically. The odds of that happening are very small. And if you do look for historic examples of that happening with lots of stocks in the U.S. stock market, you're basically talking about a blow-off top to mark the end of a bull market. Even gold stocks, if you see gold stocks go up basically double in 3 or 4 months, well, May, June, July, yeah, 4 months. If NVIDIA gets to 200 by Labor Day, it will have gone up 100% from where it was in May. So whenever you see a whole group of big cap stocks do that, you're seeing a blow off. If the mining stocks were to double in 4 months, that's typically the type of move they make at the end of a very long rally or advance, or even the end of a bull market. So the bottom line is we're in a situation now where, yes, we're breaking out. That's nice to see, but there is a risk that if this breakout continues on and on and on up until Labor Day, with lots of these fad stocks going up even crazier from here, that we're going to not simply see a pause or a correction in the fall, something like what happened in 2014 or something like what happened in 2015, but a frightening decline. Now, again, I'm not predicting this. That's not what this is about. That's not what this video is about. But it's about warning that if that were to happen, if these stocks were to go up at this rate nonstop by the middle of August or by Labor Day, that sets up a very dangerous situation going forward from there. And we've got to be on guard for what historical precedents there are in the past to understand where things might be going in the future. Now, it's June the 19th. We're not at that time period of Labor Day or the middle of August. So I'm just saying, if that were to happen by then, I would really be looking at things and looking at a very dangerous situation in the stock market. The best thing the stock market could do, frankly, right now, is pause or dip or pull back. There hasn't been any real dip at all, not even 5% all year. And the longer the market goes up without a 5% drop, the scarier and riskier the drop will be when it does come. It's like the VIX. The VIX closed today at a very low level, but on Friday it closed at the lowest low since 1993. And we've had more VIX closes below 10 this year than there's ever been in the history of the stock market. It's a record year in regards to low volatility. There's only been 2 days this year in which the S&P 500 was down more than 2%, in 2 days in which it was up more than 2%. In any given typical year, you'll find at least a dozen days in which the S&P 500 is down more than 1%. Corrections are healthy things for a market. They shake out weak hands, and it's just it gives a breather, right? When they don't happen, people get extremely complacent, and if something goes up and up and up and up, what tends to actually happen is people go on, and some people increase their bets. They get more and more and more and more fully invested. More and more and more people get into the market that shouldn't get into the market, that don't know what they're doing. The so-called lambs that are depicted in that painting getting in trouble, and so forth. And that's why I'm going to return to the phrase, bulls make money and bears make money, but pigs get slaughtered. And I will say that a better way to understand that phrase is, I don't care if you're bullish on the market or long on the market or short on the market or what you're doing, as long as you have a plan with what you're doing with your money, how you're investing or trading, that's good. You just stick to your plan, okay? I've got a very specific plan on how much money I will allocate now into any given sector of the market. So I have long positions, but I also have a plan where if the long positions I have my money allocated to go up so much, I will take some money off the table. It doesn't mean I sell everything necessarily, but I'll take some money off the table. And then at the same time, if I'm bullish on a sector and it dips, I'll actually look to buy more in order to maintain an allocation level I want to have in that sector. So if I have 20% allocated to a sector and it dips, so now I only have 18% allocated, I'll buy more to get back up to 20. It's a very simple way of managing my money, and it makes it so I'm not basing all the decisions I'm making on trying to predict what the stock market is doing. Now, I'm not saying this is the only way to manage money, but it's a way that works for me. But the key thing is to have a game plan, and it's the people who don't, that are simply throwing money at the market because they see it make a new high today, or they see Facebook go up a lot. Those type of people that just chase things, they tend to get attracted to the things that go up the most, and they may buy and see it go up for a few more weeks or even a few more months, but because they have no game plan of what they're doing, they end up saddled in at a top when things turn down and end up losing money and end up making emotional decisions on the way down. The more you've got a game plan, and the more in control you are of the position sizes in your account, whether it comes with ETFs or stocks, the less decisions are going to be made based on emotions and spur of the moment, fear and greed signals that you're getting and reacting to stock market swings. Right now, there's no fear, of course. No one's worried or scared at all. The market hasn't dropped in for so long, no one can remember what it feels like. But this market rally is not going to go on forever. I'm not saying it's over. I think the odds are it's going to continue a little more. I can't predict when the end of it is going to be, but there are dangerous precedents that the longer this goes on without a pullback, the riskier the next drop, when it does come, will be. And that is just to reemphasize, you got to have a game plan on what you're doing with your money, whether that's using stop loss orders, having a specific asset allocation for stocks that, if it goes beyond that allocation, you're willing to sell to pare back down. Whatever it is, you got to have a game plan. And that's what I got to say today. And I'm watching this market every week, reevaluating things. And I'm also looking at other markets because not everything has gone up as much as Facebook has this year. And I see exciting developments in other sectors. Gold and gold stocks have been in a consolidation now for 12 months. And the GDX is near resistance. I think it can break out of the $23 resistance level, or 23.5, somewhere in that zone. And when it does, I expect it to rally and do very well. So there's opportunities out there. But every opportunity that's out there is only going to work if you got a specific game plan. Maybe you need to write a game plan down. But there's so many people that are just getting into these markets really not with a plan at all, just reacting to some hype on television. There is a segment on CNBC that I actually posted on my website where they interviewed the CEO of Ameritrade. He said that in the last quarter, this last quarter of this year, they opened up more accounts for individual investors and traders on Ameritrade in that 3-month period than they did in the entire 12-month preceding period. So we're in a situation now where, yes, as a whole, insiders are not buying shares, not corporate CEOs. If you compare their sales or their buys, they're not buying. You study some of these companies and you'll see, in fact, that some of the popular ones are the insiders are dumping. I'm talking about the board of directors and management. The 5% shareholders are dumping tens and tens of millions of dollars worth of their own holdings and cashing out. But the individual investor is back this year. The type of person that back in the day they used to call the lamb. He's thriving right now, but when the market gets out of control at some point and the trend changes and the bulls and bears and professionals start really running around, the lamb without a game plan is going to be in trouble. And some of these lambs are best described as pigs when they're going on margin, when they're doing crazy stuff, they're buying calls to really try to gamble it up. So I'm just here doing this video to try to sound a note of caution. Hopefully someone out there will heed that message and we'll go forward from there. So it was good talking with you. Subscribe to this YouTube channel if you're watching off of YouTube. Get on my free email list for my action updates. Watch some of the older videos we've done here, and I'll be talking with you later.